All right, for today's highlight, got a lot of things going on. Market correlations, patterns, a little bit of order flow. What do you mean correlations? If you're just watching the market that you're trading, you're missing a lot of big, important pieces. Dave, who's on our radio show, talked about the Russell. This was just around 855 Central. The Russell has some swing lows. What are they? They're all in here. The Russell's small cap index. Faster something moves, the more relevant it might be. So if I go, look at that. Look at that. Look at that. That's important to notice to see if you are trading a stock index. If you're an S&P E-mini trader, if you're a NASDAQ trader, if you're a Russell trader, know what the others are doing. Take a look at the bottom left here. This is the NASDAQ. The same time that the Russell blew out the bottom of their box, they were doing the same. Let's back it up a little bit. Take a little lower left. They both blast out of the bottom of their box at the same time. Here's what's at play. The bottom of, here's a swing low, here's a couple swing lows, here's the box, here's the move through it, right? That's the direction to the downside. Right there. That's this move right here, blowing through what was good support. All right, that's the market correlation element. The pattern is the consolidation box that you could draw in here and that you could draw in here in the NASDAQ. So you have a pattern, you have direction, and you have correlation as part of that highlight. Now, order flow. Take a look at our puke tool that shows this is the same time that the NASDAQ and the Russell blew through the bottom. Here's what the S&Ps were doing. And they had this longer box that they had been banging back and forth through in the first essentially half hour from their open. The middle of it, if you listen to us, is always important. And once it gets through the middle of it and then the NASDAQ and Russell do their thing, it has a chance to attack the bottom of their range, which it did. And the anticipation for the downside to be the right side was here instead of here. So correlation, pattern, and then order flow. What does that mean? Well, down in here, while it was tough to buy it if you were looking to get long, when I say it was tough because it didn't just go straight up, it had to go sideways and then up. It showed that it could turn down there and definitely was a place that if you were short, we said, do your due diligence and cover it because a buyer showed up, some aggressive selling showed up, and it couldn't go down. So that generally means it could pop. Little tougher to open a long position, but certainly easier to close a short position and not reach and get short down in here because a beach ball underwater was possible. And that's the order flow. Buyers showed up as an iceberg, sellers hit it right away and couldn't get it to go down. And so it just lifted back up. So you got a pattern, you had market correlations, you had some sell stops being released through the bottom of a box in multiple markets, and then you had order flow calling a pivot and turn back up. Real-time analysis. You have to be able, as a lawyer put it in the room, you got to be able to ask the question and listen to the answer at the same time. While you're thinking of your next question, you're listening to the previous answer and moving forward. Real-time analysis. It's missing. It's a weakness. And whether it's order flow or patterns, it'll certainly give you the probabilities and then the objectivity. Keep yourself safe. Subscribe to this room. We're in the last 100 to 1,000 on the channel.